Thank you, Mark. Thank you for appearing, Tiff. Welcome to the committee. Always interesting to have you guys over. One of the numbers that I always like to ask you about is Canada's growth. And again, and it may be a compliment, nobody else has been able to predict it in the last 2 years, so you're part of the same batch. But we haven't been able to predict the last quarter in terms of what our economic growth is going to be. You, I think, were quoted saying, "Let's not obsess about it. Let's not worry about it. Let's not panic." But shouldn't we be panicking? Well, from a government point of view, because it's going to affect government's revenues, and then it's going to have some other spin-offs. But let's just stick to the prediction of the last 3 months, and tell me why I shouldn't be obsessed or panic about it.
Well, the point in that response was that we were trying to, my colleague and I last week, were trying to focus on what the core drivers were of growth over the course of the horizon. There's an adjustment, there's an important adjustment in the third quarter on the housing side, is our expectation. It's an adjustment, it's a level adjustment. I'm not saying that it's not important, but that's not something that we see persisting all the way through the forecast horizon. That's the first point. Secondly, there's elements of weakness on the net export side, particularly in the third quarter, in our estimation, that are also helping to keep the level of growth below 2%, more precisely 1.6% in our latest forecast. What we see is the pace of growth, and we've given our quarterly projections in the document, as you know, picking up from there. Not as rapidly to make that up, but into 2.5% and then beyond going forward through the forecast horizon. So that the point we were trying to make, not that it's not important what the level of growth is at any point in time or any quarter, but what the underlying drivers are, and I'll finish with this and pass back, is what we are seeing or what we're predicting over our forecast horizon is some moderation in consumption and some displacement of activity towards investment, very importantly, and on the margin, much less importantly, but on the margin.
In English, displacement in investment, what does that mean?
In business investment. We see an important rebound in business investment, which began in the second quarter and picks up through the third quarter, very importantly, and into the next year. And that is, and I would say, for understanding our projection, that is central to the dynamics of this projection. If that momentum in business investment, which has just started, does not persist, growth will be lower, all things being equal.
Yeah, I think that's obvious. But the part that bothers me is that Canada is normally ahead or slightly ahead of the American growth numbers, and the fact that we're below American growth numbers is
importantly with Canada, the difference between Canada and America is that Canada is already back to its level of activity that our economy had before the recession. America will not get back to that level until early next year. That's the first point. And then there's a much bigger difference, as you well know, in the performance of the labor market. The second thing to recognize is that the potential growth of the American economy, the sum of productivity and labor input, is faster in our estimation than the potential growth of the Canadian economy. So
that was going to lead me to my next question. So in terms of productivity, you're saying, I think you were also quoted as saying that the productivity is actually look much brighter for Canada, but and I don't want to misquote you, but in the end, the numbers don't reflect that. So I'm just wondering, is it policy or is it environment? Is it what is that attributable? What factors is that attributable to? And before I forget, just and maybe you can, where do I see it in your in the policy for the monetary policy report for October, the difference between the U.S. growth and the Canadian growth? Is that the table chart 2 on page 4?
We've got about 45 seconds.
Yeah, very quickly on that. If you look, you have to use table 1 and table 2 in the document to compare the two annual levels of growth. We give more detail on the Canadian forecast because we do a quarterly one in table 2. Pages 10 and 22, thank you. On the productivity issue, we see Canadian productivity picking up over the forecast horizon. There is a box in here which explains why and how and to what extent. That said, it does not pick up enough to compensate or to get us back, I would say, to the levels of overall potential growth that we enjoyed earlier this decade. So if you thought of the Canadian growth being around 3% real terms, sum of productivity and labor input earlier this decade in the 1990s, we're getting back to about 2%.
What I'm looking for, is there any government policy that can help productivity?
There is, but we're out of time.
That's a big question.
Yes.
We'll have to follow that up in later rounds. Monsieur Carrier, s'il vous plaît, pour 5 minutes.
Mr. Carrier, for 5 minutes. Thank you, Mr. Chair. Good afternoon, Mr. Carney. It's a pleasure to see you again, and welcome to Mr. Macklem, who I do not know, but I am looking forward to hearing from him. So my question is regarding the regions that you address on page 4 in your report. You say that the recent changes have shown significant differences in the regions in terms of economic growth, and you have graphics dealing with the various regions and countries. And when you address the issue, have you also considered our Canadian regions, Canada, which has such diverse regions? I don't believe you've addressed that in your report, so I'd like to perhaps hear you a bit on how you deal with data on Canada's various regions. And yes, so thank you, Mr. Chair. Well, briefly, with regard to the differences in global regions, yes, there are significant differences in growth rates in emerging economies and advanced countries, and that's one of the factors leading to difficulties in the economic recovery. With regard to Canadian regions, indeed, we do closely monitor differences in growth rates and growth factors in various Canadian regions. We have regional offices that compile data and do research, but we do not provide an official forecast for each region. Why? Because we manage the monetary policy of Canada as a whole. Well, let's say out in Western Canada with the oil sands, the economy there was growing quite impressively, and that would perhaps increase the value of the Canadian dollar, which would impact other Canadian regions, for instance, that depend on exports to the U.S. And so when we talk about an interest rate that is set on a Canadian average, it could be place certain regions at a disadvantage. So this isn't something you take into account? Yes, of course, Canada is a vast country, and we consider stats from across Canada, but there is a single monetary policy for Canada. There are significant adjustments that have to be made within Canada, and the more flexibility we have across provinces can help. An important thing that we've learned in recent years is that the flexibility in Canada has improved, and that's a positive. When you look at the different regions, clearly there are always some that are stronger and others that are weaker. But when you look at things over a given period, and especially for inflation, because our mandate is to monitor inflation, there has to be convergence in the inflation rates in the various regions. And so we need to have a national policy, an inflation target policy. Thank you. You have 45 seconds left. With regard to the long-form census, which will no longer be mandatory, will that affect your a compilation of data in order to do proper forecasts. Our work with Statistics Canada, I'd like to inform you that we work in close cooperation with people at Statistics Canada in order to better understand all the statistics produced by that agency. And our close cooperation continues. Thank you. Thank you, Mr. Carrier.
Thank you, Mr. Chair, and I want to thank our guests for coming today. And I'm going to start with a very broad question, maybe two of them, and then maybe get a little more specific about the report so I can understand. I learn something every time I read these things, or at least I think I do, and need your advice or your guidance on this. To me, personally, much of the economy is driven by confidence. People have confidence, they spend, things grow. If people tell you it's growing, they believe you and they keep going. And my issue is this, and I asked the economists that were here before us before. So we're talking about a growth rate that's less than 3%. And the indication of that is that it's negative. But if we are at 2.6 or 2.8, you know, some countries I noticed in here are way up there at 9 for China, for example. But, you know, Europe's at 1.1, Japan 1.3, the rest of the world 3.6, United States 2.3. Why is 3% such a magic number? Why can we not be happy with 2.5% growth? Why can't we say, well, look, we're growing. Things are moving in the right direction, and we need to continue on that path. Tell me why 3% is that magic number, and who came up with that?
We wouldn't ascribe that 3% as a magic number. I mean, 3 is obviously larger than 2, and that has something to do, I guess, with people's attachment to it. But there's something else that has to do with people's attachment to 3% with respect to Canada, which is that was our rate of growth of potential, more or less, for many years in the recent past. But importantly, that rate of growth, the speed limit, if you will, of the economy, the rate at which we could grow, all things being equal, if we had aggregate demand and supply and balance, that the economy could grow without creating inflationary pressures. In other words, the rate that the economy could sustainably grow. It was a product of, it always is a product of both labor input, so how many people are working and how long do they work, and productivity growth. And our demographics in the 1990s, 2000s, early 2000s were such, with people working longer, with more much higher female participation rate in the labor force were such that we, and just the demographic tree was such, and when I say longer, I mean longer into their careers, not necessarily longer hours, but longer in their life. That the combination of all those factors was such that we had a very important contribution of labor input on the order of 1 and 1.5, 1 3/4, depending around.
So based on that answer,
but if I may continue, Mr. Wallace, those demographics are starting to move away from us.
Okay.
And so, and they will continue to move away from us, just as they have in Japan, very importantly, and in much of continental Europe.
Okay.
And so, increasingly, the preponderance, the vast majority of growth in Canada will come from productivity growth, which will explain why sometimes we seem unhappy with the level of productivity growth in the recent past.
Because if productivity growth was higher, that number could be driven higher. You talked about sustainability in your answer. And based on that answer, I'm to understand that previously we could grow at 3% level, and it wouldn't generate inflation. I'm assuming generating past the 2% mark, because there will be, inflation isn't a bad thing as long as it's under control. Is that, or do we really want inflation at 0? That leads me to my second question, which is following up on what Ted was asking about. Like, where do you see inflation going? Like, what is 2% was an agreed amount in an agreement. If growth is lower, what does that do to, is our inflation flexibility lower then too, or where are we going with that?
It was about 40 seconds.
Well, no. What matters is the growth of demand relative to the growth of supply, and the balance between those in the economy, to ultimately for their impact on inflation. And so, if we have a lower speed limit in the economy, as we do now, a speed limit that towards the end of our projection horizon is closer to 2%, certainly is 2% rather than 3%. That means we need to manage monetary policy, given all the other factors that are influencing demand, such that as growth approaches that level, as the economy approaches that level of potential, that the economy will grow consistent with that growth of potential, and that will maintain inflation at the level desired and delegated to us by the Government of Canada. I would say, though, yes, inflation is a bad thing. And what particularly is a bad thing with inflation is unpredictable inflation, volatile inflation. We want low, stable, predictable inflation because business people can't make decisions when they have volatile inflation. The poor are hurt far more than the rich because they can't hedge themselves against inflation. And people have to spend time thinking about inflation and where it might be instead of focusing on the things that are truly important to them. And it's far better that we do our job properly and achieve that low, stable, predictable level of inflation so Canadians can focus on what's important for them.
Thank you. Thank you, Mr. Wallace. Mr. Szabo, please.
Mr. Carney, the elimination of the long-form census has prompted you to express some concern that it's going to take away from your ability to track the Canadian economy and also to formulate monetary policy. Have you been able to identify other alternatives to get the information that you would need? And with these changes, how do you expect these changes to impact the quality of your analysis and the impact on your operational budget?
Thank you for the question. Well, the issue, and I'll be absolutely clear what I have said and we have said with respect to this issue, is that there could be an impact on some data. We don't know what the impact is, and we won't know until for some time after the National Household Survey is conducted, after Stats Canada gets the results, after that's all analyzed. What we have done is set up a working arrangement with Stats Canada to work through that set of questions as the information becomes available. And what I would like to assure the committee and Canadians is that the bank will ensure that we have adequate information to conduct our responsibilities, discharge our responsibilities with respect to monetary policy. We are working closely with Statistics Canada to do that. We'll continue to do that over the coming years in order to ensure that's the case, regardless of how they perform their functions.
I have no doubt, sir. If I might switch to the budget 2010 and the economic update that we received, and one of the things we noted is that over the period ending in the 5 years ended 2014-15, that the economic update shows that the cumulative federal debt is going to increase by $6.6 billion. Okay? There's going to be an increase compared to the budget. However, the public debt charges over the same period, budget versus the economic update, are actually going down by $10 billion. $6.6 billion increase in public debt, but a reduction of $10 billion in charges. Seems to suggest that maybe the government has some of its own forecasts on interest rates over that period, and I wonder if the revisions that we see in this do reflect a real change in their view, and I'm wondering if these expectations actually match your expectations over the same time frame.
Well, thank you for the question. This is it's not something that we perform a detailed analysis audit of if you will, of federal fiscal projections. The federal government uses external forecasters for the fundamental inputs for that analysis, as you know, and they use the average of those external forecasters. So I will only hypothesize that the adjustment in the debt charges is importantly affected by the level of interest rates. Obviously, that the debt charges are the product of the interest rates, long-term interest, long and short-term interest rates, duration weighted, and the level of public debt. There has been an important reduction in the level of global and Canadian long-term interest rates in between the spring and the fall, given the global outlook, and that adjustment, I presume, has extended over the forecast horizon for private sector forecasters. But it's to them and to federal finance that the question is best directed.
My time is almost done, but let me just pose to you the whole issue of bank reform. That I know that you're interested in. Others have called for consideration, even though Canadian banks perform reasonably well on a comparative basis. What is the state of discussion in terms of bank reform? Is it possible? Is it mission impossible? Are we going to be successful, or are we going to fail on it?
No. Well, the good news is that since we last met we were last before this committee, considerable progress has been made on bank reform, most importantly agreement on the Basel III capital and liquidity measures. They were endorsed this past weekend. They were reviewed and endorsed this past weekend by ministers of finance and governors of the G20. They will go to leaders in Seoul. This package considerably improves the quality of capital for banks, the liquidity they have to hold, the level of capital, increases the level of capital they have to hold. It introduces a series of measures and adjustments that are much more akin to the Canadian system on a global level. My colleague, Mr. Macklem, chairs the important committee of the Financial Stability Board, which oversees the implementation of measures such as this and ensures that, because this is the very important point, it's great to have a system that's more like Canada on paper, but it's only really useful if everyone actually implements it. And an important part of this process, and if we have time, Chair, I'll ask him to expand, is ensuring through a peer review process that our peers around the table actually become more Canadian, not just talk about becoming more Canadian.
Okay, I'll make a note of that, and because we are over time on this round, but we will come back to that. I have Mr. Hebert, please.
Thank you, Mr. Chair. Good to see you, Mr. Carney, Mr. Macklem. Mr. Carney, in your opening statement, you mentioned 3 downside risks. One of them was a more pronounced correction in the Canadian housing market. I'm wondering, is your view a pan-Canadian correction or potential pan-Canadian correction, or do you see pockets of strength, as in the Lower Mainland from where I come?
Well, just like we don't publish regional economic forecasts, we don't publish regional housing forecasts, so I'm going to avoid that question. Not even skillfully, I'm just going to avoid it.
Fair enough. You also referenced, without answering, a question that was posed by one of my colleagues. The question was, what can be done to increase productivity? And you didn't really answer the question. You ran out of time. Right. What could be done? What could the government do to spur greater productivity in Canada?
Well, there's a host of policies that need to be put in place to enhance productivity in this country, and I would say that, and they're required from both the federal and provincial levels of government. I would say, on the whole, over the course of many years, successive governments have put in place a number of the factors that should bring about an increase in productivity, and we would, and those include very first and foremost having our macroeconomic policies in order, sustainable public finances, inflation under control, competitive taxation both on the corporate and personal level, liberalizing tariffs to enhance competition there, measures to enhance research and development, and then very importantly a series of investments in human capital, particularly at the university level, so that we have the people to help drive productivity. But we still have a productivity issue in this country, without question. Our overall level of productivity is about 80% of the United States levels. We importantly, there is a chart in here, I believe it's chart 15 or so, I'll confirm that, which shows unit labor costs in Canada versus United States over the course of the last decade. The bottom line of that is Canadian unit labor costs have gone up 80% since 2002. U.S. unit labor costs measured in the same currency have gone up 10%. So that gap is just one measure of the loss of competitiveness of our industry. So more needs to be done. It's a bit of more of the same, I would say, on the government side, and I don't want to be too prescriptive, obviously, to you on these measures. But also, very importantly, Canadian business needs to invest, needs to take advantage of a financial system that's functioning, needs to take advantage of opportunities that exist in emerging markets. We have just started to see that rebound in investment, and I'll make one last point. We've also noted in here the level of investment in this recovery versus previous recoveries. It is surprisingly weak. In fact, investment is only about chart 6? Yeah, 26, thank you. Is only about 15% of the level it would be at this stage in the recovery normally. So that started to turn around, but it needs to continue, as I indicated earlier in remarks.
We had the beginning of a conversation about inflation. What's magic about 2%, and what's the alternate that you're looking at? Do you want to take that?
They do it for you.
Well,
They do it for you, yeah.
with respect to 2%, I think what is very clear is you want a rate of inflation that is low, and in terms of delivering it, you want to focus on low, stable, and predictable. There are some good reasons why you might not want to go all the way to zero. Since renewing the target at 2% in 2006, there's been a considerable amount of research looking at what would be the best rate of inflation. On balance, I would say the research tends to suggest that it might be a little below 2. Having said that, it's certainly clear 2 has worked very well. Our economy has performed well. Our macro management has been quite successful. So it's a high bar, and I think you'd want to consider carefully the success we'd had before you made changes.
Mr. Carney, you made reference to a possible alternative method of regulating the inflation rate.
Yes.
Very briefly.
Very quickly, it's called price level targeting, and the idea there is that whereas inflation targeting, what happens presently is we get up every day, and believe it or not, the first thing we think about is how do we get inflation to that 2% mandated target over the forecast horizon. So 12 to 18 months out. That's what we think about. Bygones are bygones. What's happened in the past is the past. Every day we get up, we worry about that. On price level targeting, bygones aren't bygones. So if inflation was higher in the past, we'd look to make sure that we made up with some inflation that was lower, so that overall the level of price level grew at whatever level was dictated under the agreement, whether it's 2% or 1% or 0%, and obviously the converse. If inflation was lower in the past, the effort would be to get it back up. I'll make one final comment on it, if I may, Chair. There is some discussion in the public domain about the utility of price level targeting for other jurisdictions in an environment of intense disinflationary or deflationary pressures. So, for example, in Japan in the 1990s, this was looked at that time.
Okay, thank you. We'll go to Mr. Bryson, please.
Thank you. For the second straight report, the Bank of Canada has downgraded growth projections, and you have indicated concern about productivity levels in Canada and the stagnant productivity growth in Canada. When we consider the relative weakness of Canadian productivity numbers and the impending demographic shift, what is your forecast for Canadian standards of living for the next several years? Where do you see standard of living going? Because for Canadian families, this is a very important question.
Yes. Well, thank you. We do see an improvement in, steady improvement in the standard of living for Canadian families, albeit at a rate less rapid than in the 1990s early 2000s, because of productivity growth is not accelerating, will not accelerate, I should say, in our opinion, fast enough to make up for the demographic the demographic drag. It's a little too strong to call it a drag, but the less rapid contribution from labor to growth, labor as a whole on an economy-wide basis to growth. So we see a less rapid improvement in the standard of living, and the only way to get that up is to get productivity up.
I find it difficult to understand how we'd see any strengthening of standard of living if the demographic shift combined with productivity challenges we already have. Where do you see that growth in standard of living coming from?
Well, the growth in standard of living, there is some productivity growth, which picks up over the forecast horizon and yields the rate of growth of potential, which is, if you look in the chart or the table on page 22 in the English version, we have potential growing at 1.8 in 2011, 2%, as I said earlier, in 2012. That's the underlying improvement in the standard of living, or in the growth, in real growth in the economy, the speed limit of the economy. That's not the precise level of growth we see, but that's the underlying improvement. And if you think of that 2% potential growth extending out into the horizon, that's the potential, if you will. And that provides a growth to the standard of living in the
Thank you.
Maybe if I could just add one, can I just add one point? It's worth stressing the other element of the welfare of Canadians is getting the economy functioning at its level of potential output. At the moment, there are unused resources. So if you go back to Table 2, what you see is we're growing above potential growth through this projection to absorb those excess unused resources in the economy. So the first step is to get the economy sort of fully utilizing its resources, and then the other part that you want to pursue at the same time is getting the underlying growth rate as strong as possible.
Thank you. On October 19th, your press release suggests that Canadian growth will rely more on net exports in the future. And you say in that report, quote, the strength of net exports will be sensitive to currency movements. I interpret that as a signal that the Bank of Canada will be watching its monetary policy closely to avoid an ascension of a dangerous ascension of the Canadian dollar relative to the U.S. dollar in terms of its impact on our economy. How do you reconcile that statement with the government's crusade against currencies being artificially low in some countries? And how do you reconcile the government's public statements on competitive devaluation with the bank's positioning of the loonie against the U.S. dollar? Isn't there a pretty clear contradiction there?
Well, two things. First is that we see a contribution of net exports to growth in 2011, but it's a modest contribution. It's 0.3 on a rate of growth of 2.3 in 2011. The second thing is, yes, that will be sensitive. It's sensitive to productivity. It's sensitive to demand in the United States. It's also sensitive to currencies. The reconciliation I would make is, I'm not going to reconcile with the government statement per se, but to reconcile with a different part of the press release, which notes heightened tensions in global currency markets, and which relates to the discussion we had earlier with Mr. Menzies on the efforts to resolve global imbalances. There are heightened tensions in global currency markets. That does create a risk for the Canadian economy and through the net export channel and back into the economy, including through confidence effects, as Mr. Wallace had raised earlier. We are very alert to that, and we do watch developments in these markets closely.
Okay, thank you. Monsieur Généreux, s'il vous plaît.
Mr. Généreux, please. Thank you, Mr. Chair, and thank you to the witnesses. Welcome. You pointed out, Mr. Carney, that private investment will help increase growth, and I agree with that statement. you must know that the government is committed to reducing the corporate tax rate to 15% by 2012. And yesterday we heard from the Banking Association of Canada, the Quebec Employers Council, who believe that this is a very effective measure to ensure the growth in corporations and job creation. Do you support such statements? Excuse me, what exactly are you referring to? Well, the fact that our government committed to reduce the corporate tax rate to 15% by 2012. Well, thank you. That's it's a bit delicate to give advice on taxation here, but as I've indicated in response to Mr. Hebert's question, there are a number of factors that have an impact on business output here in Canada and elsewhere. The level and the structure of the corporate taxes and of personal income tax have been lowered, so the competitiveness of the system as a whole is an important factor that will impact the productivity of our companies and the level of investment, as you've indicated. Another element that I find of interest are the currency rates. We're at par with the U.S. dollar. At one point, the Canadian dollar was around 60 cents U.S. We often hear the whole issue of the export situation in Canada is affected by the currency rates, and the fact that our Canadian dollar is at par might be difficult for certain industries. Do you believe that in the close future that the exchange rate could become more favorable for exporters? Well, I wouldn't want to make a too specific comment on the current currency rates. I apologize, but that's sensitive information. But as we've discussed in the previous discussion, there is a risk for net exports. That is to say that a too high currency rate and a too strong dollar are two risk factors. And we monitor the situation closely. We monitor that risk very closely, and we will see. But ultimately, it is the responsibility of the Bank of Canada to manage monetary policy in order to achieve our inflation target, not the level of the exchange rate, but the inflation rate, which is 2% based on the total CPI. But all those elements are interrelated. The exchange rates and maintaining the inflation at the lowest level possible. There has to, of course, to be a balance, but does the perfect balance exist? Well, we would want to increase the productivity of businesses, and that's something we all agree on in order to improve Canadian growth. But if I might say, maintaining a too tight control on monetary policy becomes contradictory. What is important and what is crucial for our economy is that our businesses have to increase their productivity. That is clear. Ultimately, that is a clear factor. Thank you. Mr. Mulcair, please.